You brought up a point in there is like the internal rate of return. One of the investors locally asked me, said, he used to be a private investor for me in the real estate space, and he says, "Well, what would be the rate of return for buying businesses?" And I said, "Well, usually at least 33%." He
Yeah,
goes, "That's not real. That's not achievable." I said, "It is." I said, "The reason you get less than that on other transactions is you're trading the liquidity, being able to be liquid for a higher rate of return. You buy a
absolutely.
small business, it's not nearly as liquid. It takes time to, if you decide you want the money back out, you got to put it on the market it, sell it, and you got to be running it well while you're doing that, or it'll depreciate. So, but it is very common to get those type of rate of returns inside of a business. And
Well, and you can leverage those returns. So we'll go back to the SBA analysis. So let's say you and I decided to go out and buy a company making $1 million a year, and we could buy it at a 3 multiple. So we pay 3 million for it, and we put down $300,000, and we borrow 2.7 million from the SBA on the 90% loans they're doing, and we qualify for it. The business qualifies. So now we have 300,000 of equity in the business, and it's cash flowing $1 million a year. We're now going to direct, some percentage of that to service the principal and interest payments on the debt. Every month we pay down principal and interest, our equity in that business grows, just like the mortgage on your house. So you grow the business, you pay down the debt. 3 years later, you turn around and sell the business, and if you sell it at the exact same multiple, you've gotten a much higher return on your equity. Now, in terms of at-risk capital, the SBA is going to require that you personally guarantee and pledge, and so you have the risk, but you know, in a lot of PE firms, there is a multiple expansion run between small businesses and lower and middle market businesses. So the typical small business is going to trade around 3. The typical middle market business is going to trade at 6. So when we do see PE firms dipping into our space, what they're doing is they're looking to take a platform and start bolting on businesses so that they can aggregate and get to middle market and then just bank the multiple expansion, right? So I
right.
buy businesses at 3 and then I turn around and sell them at 6. I haven't necessarily improved the business. All I've done is position the business to a different buyer who has a lower return requirement. So that game plays as well.